This video is going to cover everything you need to know about investing in real estate investment trusts versus investing in real estate syndications, and why one way is way better at protecting and compounding your personal wealth. So we're going to start our story with two fictional characters, Pete the REIT investor and Sydney the syndication investor. Now, both Pete and Sydney work at a technology company called Hooley. They make $300,000 a year of combined income with their respective spouses. And at $300,000 a year, their take-home pay is $183,000. I've used California tax rates here. We have federal income, state income, social security, all that stuff. The net pay is $183,000, and their estimated taxes is $117,000. Now, both Pete and Sydney each have $1 million to invest, and they both want to focus on long-term durable wealth, so they decide to invest in real estate. Now, both of them understand real estate, but Pete is missing something. Both of them understand cash flow. Both of them understand the appreciation benefits of real estate, but there's something which Pete doesn't understand, and it's why Pete chooses REITs and why Sydney chooses syndications. But they decide to invest in their own respective strategies. The $1 million question, who makes more money? Let's go through it. So Pete, the REIT investor, goes online, he looks at REITs that he could invest in across all the big names. He decides on Avalon Bay Communities, which is one of the biggest multifamily operators throughout the United States. He looks through their 10K reports, sees they have a couple hundred different communities across the United States. He goes into Interactive Brokers, he puts in a buy order at $160, and it gets filled. Pete now owns 7,000 shares of ABB, or Avalon Bay Communities, for $1 million. Let's go through Pete's investing experience as part of being a REIT investor. So first and foremost, he gets his quarterly dividend distribution. Then he has an up and down roller coaster of the stock market. This is the chart over the last 5 years of Avalon Bay going from 150 to 200 to 150 to treading water to 250 down to 150. And then thirdly, he has these 10K reports. He looks at understanding communities, but there's a whole lot of numbers in here, a lot of text. It's super high level, but nevertheless, he appreciates that he gets regular updates. So what's Pete's overall investing experience? Quarterly cash flow, lots of ups and downs, and in the clouds reporting. Thankfully, it works for Pete. Now, Pete collects a 5% annual dividend yield. Avalon Bay had 4%, but let's use round numbers and call it 5%. So $1 million times a 5% dividend yield gets Pete $50,000 a year. Now, this $50,000 is dividends, and dividends are taxed at ordinary income. This is a really key point to understand. The higher your income tax bracket, the more the dividends actually taxed because it comes through as ordinary income. So let's look at the updated tax forecast for Pete, the REIT investor. At $350K per year, Pete's take-home pay is now $209,000. All the same stuff, again, based off California tax. The new estimated taxes is $141. What does that mean after all? Well, it means that Pete's W2 income stayed exactly the same. He had REIT dividends of $50,000, tax payable of $24,000, new cash flow of $26,000. So Pete was able to increase his cash flow by 14%. Go Pete, not bad. Let's look at Sydney. Now, Sydney chose to invest in real estate syndications instead. Syndications like this is a multifamily project in North Carolina. Now, Sydney's read about syndications online and watched his favorite YouTube videos. And Pete understands that syndications give him direct ownership of the real estate. Now, what does direct ownership mean? Well, in any syndication, there's two different parties. There's a general partner who's responsible for sourcing the asset, executing the business plan, and brings expertise, experience, relationships, know-how as far as getting the deal done and making sure it achieves its goals. There's also limited partners, which is the second group. Now, these limited partners pool their capital and sit alongside the GP. And as part of that, they get their returns, distributions, operating updates, all that sort of stuff. The best way to find these is online with trusted platforms like HoneyBricks. And let's look at Sydney's investing experience. So Sydney collects cash flow every month from his syndication he invested in. He feels part of the journey looking at before and after shots of the different projects he's involved in. He also gets tangible and educational investor updates, operations, capex, occupancy, really tangible experience of understanding real estate. So Sydney overall gets monthly cash flow, feels part of the journey, and he gets to learn about real estate. Now let's assume Sydney gets the same cash flow returns as Pete, the REIT investor. So $1 million times a 5% cash on cash return is $50,000. But these are not dividends. This is a really key point. Syndications pass through rental property income and expenses to their limited partner members. So those LPs that were sitting in that project, they get the income and expenses. What that means is those LPs, like Sydney, gets the benefits of tax advantages, including depreciation. Now, this is what it looks like at the end of the year. Sydney gets a K1 from his partnership. And you can see here, net income is a loss. How can that be? Sydney was collecting cash the whole time. Well, this is the third piece that Pete, the REIT investor, was missing. Both Pete and Sydney agreed you get cash flow from real estate, you get appreciation from real estate. It's only in syndications do you get depreciation benefits of real estate. You don't get these in REITs. How does depreciation work? Depreciation takes the property value, excluding the land, because you can't depreciate the land, divided by the useful life of the asset. Now, importantly, depreciation is a non-cash expense that provides a tax shield on income. And let's do this to an example so we can understand how it works. Let's look at $30 million investment. We'll shoot this one here. There's $20 million of buildings and $10 million of land, and this will be classified by the tax or accounting team of the actual investment. This is funded through $20 million of debt and $10 million of equity. Now, this $20 million buildings is what we're going to focus on for understanding the depreciation. So the $20 million building is depreciable over 39 years. Now, there's different cost segregation studies and stuff like that you can do to modify this, but we're going to keep things simple. Now, you take that $20 million of buildings divided by 39 years, you get to a $512,000 annual depreciation charge. Now, Sydney invested $1 mil of the $10 mil equity for that project. What that means is take that 1 over the 10, Sydney's ownership is 10% of that investment. What that means is Sydney gets 10% of the tax advantages like depreciation. So 10% of those tax advantages, which were $500,000, is roughly $50,000 of tax benefits. So Sydney's taxable income, and this is a really key point, is the 50K distributions less the 50K depreciation is at zero. Taking the W2 income less the new cash flow, Sydney's real estate investments gets him to $233,000. So Sydney increased his cash flow by 27%. Now let's compare Pete's experience, REITs, and Sydney's experience in syndications. Here we have the exact same W2 income after tax, then different real estate earnings. The REIT investor and tax payable 24 grand, net cash flow of 26. Sydney, the syndication investor, had tax payable of 0, net cash flow of 50 grand. The difference is 14% versus 27%. Sydney is making 2 times the cash flow versus Pete, the REIT investor. What's the key takeaway of all of this? Well, REITs can be great investments, but you miss out on the tax advantages of direct real estate investment. And direct real estate investing means you own the actual thing. And these tax advantages, one, increase your cash flow, but also increase your opportunities to grow and enjoy your wealth. So where does that leave Sydney, our syndication investor? Well, he can use that extra $24,000 a year to enjoy nicer family holidays, invest in his children's future, and enjoy all the good things in life. That's it. If you enjoyed this content, please hit that like button and subscribe. It's incredibly helpful for us, and we'll see you soon.